So look, this week, if we see these data points come out as positive as they are anticipated or even above expectations, it might take a bit of gloss or a bit of enthusiasm off markets, off share markets and equity markets.
Matt Felsman, welcome back to Dukascopy TV. A pleasure to receive you.
Yeah, thanks.
No worries at all. Now, reporting season in Australia is over for another period. What were some of the high and low points for you?
Well, I think, look, reporting season as a whole came in a lot better than people had anticipated. We had about 2/3 of companies outside of the resources space actually report an increase in their earnings. 50% of companies that reported actually beat their estimates, and 2/3 of companies that reported actually outperformed the broader market during the day that they reported. So a lot, I won't say a lot better than people expected, but not as bad as people expected. From a positive point of view, a standout might have been something like the airline Qantas. They came in with a $921 million profit before tax, largely due to a lower oil price, lower Australian dollar. It goes to show that they're actually pulling off a turnaround story that they've broadcast to the market. They're going to attempt to do. And on a negative side, we had something like a Woolworths, for example, the retail chain, $972 million loss after tax, and largely due to the failed attempt to enter the Australian home improvement area.
Now, from companies such as Suncorp to BHP, one of the real characteristics almost of reporting season were those announcements of restructures, of simplifications, of reorganizations within companies. Now, for some shareholders, perhaps this will be a positive, showing that willingness almost to adapt to what are volatile trading conditions at the moment. But how is this shaping perhaps clients' mindset in terms of their outlook for the year ahead?
I suppose the big change in mindset or the big change in approach has come from having a real set and forget portfolio, sitting back, holding these blue chip companies that are going to outperform over the longer periods of time. We're seeing volatility returning to markets. The change, I suppose, the change in mindset I've been communicating to clients is to really plan your trade and to trade your plan. So that means knowing what companies in your portfolio you have now, why you own them. And if you are going to be purchasing companies moving forward, what company you're going to be buying, at what price you're going to be exiting. If things move negatively for you, what price you're going to consider locking in a loss. So you're really understanding what you're doing and why, planning your trade, sticking to it, and really, I suppose, just keeping it simple.
So if we look to the sort of near-term future, we've already seen lead-ins to this week trading from last week's US data. Coming up, we've got the NFP data also. It's expected consensus for around about 190,000 jobs added. How is this likely to shape the week ahead and leading into that data?
So on Friday, we saw the broadest measure of economic health in the US GDP come in at a 1% upward revision, which is obviously much higher than the 0.4% the market was expecting. This type of positive data at this time generally quite negative for markets. That's because it puts further volume into the cause for the US central bank to potentially have multiple interest rate increases for the year ahead. So look, this week, if we see these data points come out as positive as they are anticipated or even above expectations, it might take a bit of gloss or a bit of enthusiasm off markets, off share markets and equity markets.
Just to touch on that also, I mean, I've noticed in your recent commentary, you are sort of forecasting a resumption in bear markets for US markets. Why is that?
So, I mean, there's plenty of reasons for people to be pessimistic at the moment when you're looking at world equity markets. But I think the standout for me really longer term and on a more technical point of view is the US market, the S&P 500. So we've had really faltering uptrends this year from multi-year highs of last. We've had a really widening dispersion of groups within the market. So your perfect example, your Facebook, Amazon, Netflix, Google doing all the heavy lifting. And a real narrowing of participation, so less volume. And if you think that markets are forward-looking and we're not seeing a lot of funds come in right now, it means there's not a lot of conviction and maybe a little bit more pessimism than optimism moving forward. So, yeah, look, I think these are all pretty classic signs of a market that is potentially topping out. And in my opinion, longer term, especially in the US, we might see some cyclical declines.
Matt, many thanks for the update.
Thank you.
The Dukascopy TV team will bring you those payroll numbers when they hit the market on Friday. That is all we've got time for right now. I'm Natalie MacDonald. You've been watching Sydney Direct on Dukascopy TV. Until next time, it's goodbye.